Welcome back, Alpha Hunters. In this video, I want to talk about what I think is kind of going on right now with inflation and rates, the Treasury and the Fed, and what I think is probably going to be happening in the market and the economy, probably coming up here over the next 6 months. So I'm going to stepstone through a few things. That way, if you haven't been fully paying attention to everything that's been going on with the market, you'll kind of get caught up pretty quick, and then we'll get into it a little bit. But the inflation rate, as we know, last year was pretty high. Back in 2022, it was pretty high. It came down relatively sharply towards the end of last year, and even this year, it's now down to 3%, which is, I would say, good job on the Fed on getting the inflation rate down. Now, if we do look at the month-over-month view, we can see really the last major month-over-month uptick of inflation that we had back in 2022 was in June. That was the last reading that we had in June of last year that was kind of high on the monthly level. So after that, then we had the huge drop off, which is why the inflation rate last month that we got, the CPI reading that we got, was at a 3% rate that we just looked at. Now going forward, there should be no real upside kind of surprises to inflation getting and growing back as fast as it was back at the end of 2021 and the beginning of 2022. So there's been a lot of market participants that have been thinking that, hey, if inflation comes down and the Fed gets to their 2% level, and I would say they're probably mostly there, they're down to 3%, which is really dang close for where they, got to come down from. And I'd imagine a lot of people, a lot of investors are expecting the Fed to cut interest rates and bring down rates. Well, the Fed doesn't really control the interest rate market. Now, do they have a part in it? Yes, they do have a part in it, but they don't really control it. The market, for the most part, really controls the interest rates. And what we can see from, if you look at pretty much any kind of interest rate, and we're going to look at a few of them here. If you look at any of the interest rates, they don't exactly look like the inflation rate that we were just looking at, right? The yearly inflation rate that we were seeing drop off really over the past several months. Well, here looking at the 2-year yield, it looks relatively strong. We got a nice little uptrend and a little sideways consolidation pattern. Had some minor pullbacks here recently on the dailies, but it doesn't look nearly like the inflation rate. And if you look at the 10-year yield, you can see that it looks a lot stronger compared to, the 2-year yield, especially here recently. This little uptrend here, this looks a lot stronger than, even the 2-year yield looks like. And then taking a look here at the 30-year yield, you can see the 30-year yield has pushed up and is challenging the highs that it put in back in October of 2022, pushing above the past several months of highs that have kind of been set in around the 4% level. And you can see that it definitely climbed over 4%, especially in that first week of August. So why do rates, especially longer term rates, continue to push higher when inflation has come down already? Well, you could probably look at many different areas of the economy, different things, but not really going to be able to fully understand that picture. But what about inflation? Okay, is inflation really down as much as they say? Well, let's take a look at that. So I want to briefly kind of go through a few scenarios here on what it's like to get a loan, okay? Now, a few of the areas that we've seen be extremely stubborn with inflation is really anything you buy with debt. So we'll say for this example, real quick, base example, not hard, 30-year loan for 3.5% for $100,000, okay? Your payment would be about $3,500. We'll say for this scenario, we're just buying a house, right? Buying a house, 3%, 30 years, not too complicated. That's your payment. Okay, so here's another situation. We'll say same thing, 30 years for a mortgage. We're gonna say we're gonna get an interest rate for 3.5%, but we're actually gonna buy the house for $120,000. So our payment's gonna go up a little bit. It's gonna go up to $4,200. Okay, all right, fair enough. Let's look at another scenario. So here's another scenario, okay? 30 years still, but your interest rate has changed, okay? Now this time I didn't change the loan amount. We'll still say that, our price of the home we're gonna buy is $100,000. We're gonna buy the home for $100,000, and we're gonna do this using a mortgage interest rate for 7% now. And now our payment has gone up to $7,000. So as you can see, that's quite a substantial jump on how much your payment is a month. And in this final scenario here, I just raised the interest rate to 7% and then also the loan amount to $120,000, or the price you were buying for a home. Now, the reason why I did this was to kind of show you the real inflation rate for certain things in the economy, okay? So back in like 2020 to 2021, we were seeing home values, especially in different kind of suburban areas across the US, they were going up at about 20%. So that's the point of the second scenario, to kind of show you, hey, you know what? How much does your payment go up if home prices go up 20%? Well, your payment should go up roughly 20%, as long as your interest rate stays relatively the same. Now, here's where it starts to really suck if you get a mortgage. Let's say the home prices don't really change much year over year, but interest rates go up double, right? They go from 3.5% to 7%. Now, this is like the situation that we had throughout 2022, where interest rates climbed substantially, going from really the beginning of the year of 2022 to the end of the year in 2022. And actually looking and preparing for this video, looking just basically at fixed income mortgages, they were around 8%. So I'm not even factoring in the current level, which is around 8%. And you can see just how much inflation you are getting on your payment in this third scenario with your interest rate going up 3.5%. It did go up 100%. So now your payment is double. And in this fourth scenario, if you take into account the past 2 years of how much home prices have moved up and interest rates have moved up, you're looking at payment inflation rates of 140%. So when we actually get economic inflation data, that's only tracking the price side of products or goods or services. That does not factor in the interest rate inflation on any kind of debt you are using. And this is applied to basically anything that people buy with debt. Houses, cars, furniture, home remodels, even your credit cards. So when people say, you know what, I feel like I'm paying more, something about it it seems like inflation's still out there. This is because they're paying a lot more on things that they buy with debt. Because I don't know about you, but if the inflation rate just went up 10% over maybe like 2 years, going up from 3,500 to 7,000, that's not exactly 10%. And you may be wondering, okay, so what does all that mean? Well, one of the bigger entities in the world actually uses a lot of debt, the US government. The US Treasury issues a lot of debt to finance the US government in different things that the US government is trying to do. And this has been the case over the past couple of months since they passed the debt ceiling bill. But here's the problem. With interest rates as high as they are currently, this is making it much more difficult to raise the funds without having to pay a whole bunch more on interest. And we are seeing a US government debt spike go on right now. So this is where I'm going to bring it back to the Fed and the Treasury. Both of these entities are out to do what is best for the US at whole. Okay. And sometimes if you are faced with two evils, you got to pick the lesser of two evils. And those two evils that I'm talking about is allow interest rates to stay elevated and continue to climb. And the US government, the Treasury, will have to pay more in interest, which is unsustainable. And they haven't really planned for, because much of the past 15 years, we have seen interest rates at near zero type of levels. Or the second evil, continue to raise interest rates and crush the economy and the stock market to get interest rates to come lower. So do you want to have a government that can't pay its bills and can't pay its inflation? Or do you want to crush the economy and put some people out of work relatively on the short term, but to get inflation down, where you see how much interest rates really do matter when you are taking out loans? And this is where I do think that they will push interest rates higher so that they can induce an economic recession. And I'm not going to say a collapse, but a pretty good sell-off in the stock market, because they need to get interest rates much lower. So really, everything I'm kind of talking about has nothing to do with the stock market, but the stock market can see a lot of pain going forward. And another thing is, as last year, back in 2022, when we were seeing the market sell off, well, we were seeing interest rates climb. So if I bring up the 10-year yield, well, now we're back at those elevated levels on the 10-year yield, but yet we're seeing the stock market only 5% roughly from all-time highs. So if yields continue to push higher, the stock market will see some pain, and it will happen probably pretty rapidly. So that's kind of my theory about what's going on right now and what's coming down the line, as really none of it kind of equals a good scenario to kind of be in as far as like the US economy. But you got to take the lesser of two evils, and one of them, you're probably just going to induce a recession. so you can get interest rates back down. Anyways, that's just kind of my theory about what's coming. It's kind of hard to understand the timing of, anytime something like this could probably play out. You never know when it actually will happen. But the mantra of stocks go up that has taken over the equity markets is the same kind of mindset that people were in back in 2006, 7, and 8, just before the real estate market collapsed. Alrighty, Alpha Hunters, take care.